Okay, welcome back. We're just going to go through the last part of this narrative PowerPoint, which basically looks at the last few pages of the exchange balance payments and exchange rates booklet. Okay, so we talked a little bit in the previous session about deficits and surpluses on the current account, and what I've done is put together quite a nice sort of graphic which actually explains other things that might cause a current account deficit to occur, and broken this down into both structural and cyclical issues. And obviously what we can do is go through this in a little bit more detail, but in the first instance, let's just take a look at what some of the currents, the things that can affect the current account to become in deficit. Okay, so structurally, if we have underinvestment in our country, okay, that might mean that we've got less competitive industries, and that clearly can be a bit of an issue. Okay, if we're not investing in the best infrastructure, we're going to become less internationally competitive, and that clearly can be a bit of an issue, can't it? Okay, relatively low productivity. We've talked about productivity as a bit of an issue. If we've got low levels of productivity, that means our labour cost per unit is going to be at a high level in comparison to other parts of the world, and as a result of that, that's going to mean that trading goods and services are going to be less effective for us. That's going to mean that we are going to be less globally competitive. Okay, if we've got high levels of inflation, and these are some of the things that we talked about previously, that clearly can be an issue, because if our prices are going up higher relative to other parts of the world, then that clearly is going to mean that we are going to be less internationally competitive. If we're not spending enough money on research and development and innovation than other countries are, that's going to mean that, again, we are going to be providing goods and services that are less relevant and maybe of a lesser quality, or not quite as innovative as they should be. That clearly can be another issue. Okay, and obviously, if we've got changes in the structure of economies and the relative strengths and weaknesses of different countries, if we've got high levels of low-cost competition coming into our markets, that clearly is going to cause some structural changes, which is going to affect our current account deficit. Okay, now obviously those are sort of structural issues, are pretty significant, and obviously tend to be longer term, but we've got some cyclical issues too. Okay, which again could cause so this is almost to do with the trade cycle, isn't it? Okay, it may well be that we've got an overvalued exchange rate. That clearly means that if that is the case, then our imports are going to be relatively we're going to import more and we're going to export less. Okay, so on the basis of our exchange rate being overvalued. If we've got a boom in domestic demand, okay, that clearly can mean that if we've got a high level of demand, as we've said before, high levels of consumption tend to mean that we get more imports happening as a result. Okay, if we've got recession in key export markets, which again could be a cyclical thing, clearly we know all about recession from the financial crisis, and clearly we're going to have the same sort of issue with the COVID pandemic, and we're going to have recessions in key export markets, and that clearly is also going to cause issues in terms of the amount of exports we're achieving, and that obviously is then going to mean that our current account deficit will get worse. Okay, slumping global prices for exports, again, that clearly could be to do with the recession, but again, if we've got a slump in global prices for our goods and services, that clearly can be a bit of an issue, and that's going to cause current account deficits to occur. And obviously, we could always also have increased demand for imported technology. So if technology and innovation is better in other parts of the world, and we perceive it to be better, then in that case, there might be an increase in demand for imported technology, and that clearly is going to have an impact on our account deficits. Okay, if we then look at some of the issues around surpluses, okay, what can cause a current account surplus? Well, some of those you wouldn't be hugely surprised to hear, I suppose, will be almost the opposite to what we've just talked about there. Okay, so I'm not going to go through them in quite the same detail as we've gone through in the last slide, but fundamentally same sort of principles. We've got some structural issues, and also some cyclical issues. Okay, so if we look at the surplus of savings over investment, clearly in this instance, as we've explained before, essentially we've covered a lot of these points already, but we're just putting them into a graphical format. Okay, and it's quite a nice summary for you to take a look at to then assess how, if you were going to get a question of this nature, what are some of the causes of deficits and surpluses on the balance of payments. You've got a range of different options that you can choose from. Okay, so have a look at those, consider each one, maybe do a little bit more research, either looking at Tutor2U or Econs Plus Style, which actually will give you some more detail on that. But also check your booklet out, because you've got a range of quite good examples that you can use to illustrate too. Okay, so let's take a look at the next one then. Okay, so we're looking at now at the relationship between the current account and the financial account. Okay, so you have got some notes on this, some significant amount of notes in your booklet that you can have a look at, and we'll try to actually demonstrate exactly why, what the link is between the current account and the financial account. Okay, so let's assume we as a country have a current account deficit. Well, if that is the case, if we've got a current account deficit, we must have a surplus on the combined capital and financial accounts. And if we think about this, essentially, in a simplistic sense, referred to as a financial account surplus. Okay, so let's take an analogy that we might find slightly more not interesting, easy to understand. So if we're earning £25,000 a year, but we want to spend £30,000 a year, we would basically have a deficit, wouldn't we? I.e., if we've got 25 grand's worth of income, but we want to spend £30,000. Well, clearly, in order to finance that, we would have to take out a loan of some description, wouldn't we? Okay, so we'd borrow that extra money, the £5,000. Well, a national economy is no different in a sense, but it's just on a much bigger scale. So if we take as an example, the UK exporting goods and services worth £600 billion, significant amount, but actually we are importing more. We're importing 650 billion. Well, we would be in a current account deficit to the tune of 50 billion, wouldn't we? Okay. Now, in order to finance that, we're going to need to obtain enough foreign currency to be able to pay for our imports. Okay. If that isn't the case, if we haven't got enough from exports, then clearly in this instance we would need to finance that, and in this case we would be looking at encouraging overseas residents to either buy UK assets such as shares and government bonds and companies and houses. Okay, now obviously all of those transactions will to some degree be recorded on the balance of payments as credits in the capital and financial accounts. Okay, so clearly if we have got a current account deficit, an economy must have a current account surplus, a financial account surplus, in order to balance that whole equation up. Okay, so if you have got a current account deficit, then you will inevitably have a financial account surplus because you've had to finance the difference between the two. Okay, so let's have a look at this example then. Okay, in this instance we've got financial account determining, or how is that determining what happens on the current account. Okay, so we've said and we've used as an example on numerous occasions China manipulating the value of their currency by buying US government bonds. Okay, in this case, essentially the yuan or the renminbi is going to be exchanged for US dollars on the foreign exchange market. Okay, what effect does that have on the financial account for China and the US then? Okay, well, in first instance, basically China is going to be in deficit on the financial account. Okay, because they are spending money that have obviously generated from exports, but they basically on the financial account are in net outflow. However, the US is in a surplus on the financial account in that essentially it has had a net inflow of funds from the Chinese government in this instance. Okay. The effect that it has then, okay, what effect does that have on the value of the yuan and the dollar? Well, it obviously causes the dollar to appreciate relative to the Chinese yuan, okay? So it would appear on the face of it, that's a good thing for the US dollar because it's appreciated in value. However, in terms of what that effect that has on the current account, Chinese goods basically become more price competitive in the USA, and that's going to lead to more imports from China, and that's going to cause an even greater current account deficit between the USA and China. Okay, so effectively that is going to just exacerbate the problem. Okay, and to some degree, China are doing that in order to maintain that price competitive nature in their manufactured goods markets. Okay. The other thing is, there's a flip side to all of these things. The US goods are relatively less competitive in the domestic market and the Chinese market, and that causes China to have an even greater current account surplus with the USA. And then clearly what they can do is carry on this process of essentially buying more US government bonds in order to maintain the level of the US dollar at a higher rate. And also for the yuan to be relative to the US dollar less valuable, and obviously that then creates this slightly unfair situation where we've got more goods and services being demanded by the USA for Chinese goods because of this price manipulation in the value of the exchange rate. Okay. So let's have a look and see another example then. Okay, and in this case, I'm going to let you have a go at filling in this these boxes. Okay, so we've got some information talking about the financial account might determine what happens on the current account. So let's take a look at what's described in example 2 then. Between 2000 and 2008, the UK was experiencing a large current account deficit. This was caused by the UK having higher interest rates in the other developed countries such as the US and the Eurozone. That attracted hot money into the UK economy, which was recorded as a balance on the balance of payments as a credit on the financial account. Okay. Therefore, the UK had a large financial account surplus. Okay, so that was caused by hot money being attracted into the UK economy because we had high levels of interest rate. Okay, the hot inflow of money would have actually caused the value of the pound to appreciate. Okay, so remember, strong pound, imports cheaper, exports dearer. Okay, so exports would have then the price of exports would have risen. Okay, and the demand for exports would have fallen as a result, assuming, of course, that there's some sort of elastic demand going on here. Okay, so in this instance, the price of imports would fall, and so the demand for imports would rise, and as a result of that, the UK would have a large current account deficit caused by that. Okay, so we've obviously given one example of the US and China, but in the UK, this instance gives quite a good example of where a change in the interest rate can actually cause a significant change in the current account deficit. Okay, so does it matter whether we have a current account deficit? Well, one could argue that if we've got a current account deficit, it's caused by outflows being greater than inflows. What might that mean then? Okay, if we've got a current account deficit, okay, if we've said that imports are going to be higher than exports as a result of that, what sort of impact would that have on aggregate demand, real output, and employment? And this is where the typical sort of question that you might get asked, if we're talking about a current account deficit, is it a good thing or a bad thing? Being able to comment on the impact on aggregate demand, real output, and unemployment, or employment, that clearly is going to be quite a nice way to actually evaluate that type of question. Okay, so clearly, if we've got more, if we're importing more than we're exporting, that is clearly going to have an impact, isn't it? The result will be a loss of income and jobs from an economy potentially, okay? Because if you think about it and try and think about how this impacts on the circular flow, if we're saying exports generally are represented as an injection into the circular flow, and imports are represented as a leakage from the circular flow. If that happens, the value of imports are going to be greater than the value of exports. There's going to be a net withdrawal in the circular flow, isn't there? Okay, and as a result of that, if we've got that situation, the economy is going to experience an increase in the current account deficit, and aggregate demand is likely to fall as a result. Okay, so that's sort of explaining it in words, but let's also look at how that would affect real output and employment as well. And if we can look at including when we're trying to develop our answers, an LRAS and or AD diagram to explain that, that would clearly be a very positive thing, and it's going to gain you some marks because it's demonstrating good levels of analysis and understanding. Okay, so if we've got a current account deficit, okay, let's try and draw a diagram that's going to explain the consequences of a worsening balance of payments current account in terms of output, employment and inflation, obviously considering that all other things are going to be equal. Okay, we know our aggregate demand is made up of consumption, investment, government spending, and then obviously the difference between imports and exports, net trade, if you like. So in this instance, then, if we're running a current account deficit, we would represent that in this following way. Okay, so effectively, if we've got a current account deficit where we've got a fall, essentially a fall in aggregate demand, AD would move to AD1, as we can see, and that is then going to have an impact on number one, output. So output is going to fall. Inflation is also going to fall, and employment, because obviously we've got a lower levels of output, that could actually cause us a bit of an issue in terms of employment. So we've got output falling, this falling from Y to Y1. We've got employment potentially causing us a bit of an issue, because if we've got a lower levels of demand in our markets, then that might mean that we're going to lose some jobs. And also in this case, inflation would actually fall. The price level would fall from P to P1 based on this change. Okay, so let's take a look at the next scenario then. Okay, so clearly, if we're talking about whether the current account deficit is a problem, and what's the relationship between that, I'd like to take a look at the rest of the page of notes on that, which actually explains in quite a nice level of detail the sorts of things that we might need to consider. Okay, so let's take a look at how this might play out then. Okay, so if we've got a situation where the level of current account deficit is a bit of an issue, it's very much going to depend on whether it's consumer goods or capital goods that are being imported. Okay, so if you take, in some cases, the current account deficit might be helpful to grow, if it's used to help an economy grow at a faster rate. If we take as an example South Korea, in the 90s had a very high level of current account deficit, but they were using that in order to finance fixed capital and technology that was being imported. Okay, so in the long run, that would be of benefit to the economy, because obviously as you produce more and better quality goods and services, and they're more efficiently produced, that might well mean that as a result of that, in the long run, that will actually help resolve the current account problems, because of the borrowing that you've done and the money that you're spending is based on improving the overall productive capacity of your market, of your economy. Okay, so in some cases you can, dependent on what you're doing it for and how you're doing it, that actually can be a positive rather than a negative. Okay, so is it desirable for an economy to have a current account surplus? So in the same way as we just talked about, is it worth taking a look at whether that is a good thing or a bad thing? Okay, so if we then again use the same principles of a surplus in our current account, then let's take a look at what that might mean in terms of output, employment, and inflation then, okay? So in this instance then, if we've got a current account surplus, we are going to be finding that we are going to have levels of aggregate demand increasing. So we're going to go from, in this case, AD to AD1. That is going to mean that we're going to have higher levels of output as a result of that. So Y is going to move from Y to Y1. Output is going to move from Y to Y1. But also we are going to have, only going back one, some inflationary pressure. Okay, so if we've got high levels of a current account surplus, that is going to essentially create some inflationary pressure. Okay, because effectively we've got high levels of demand, and that might well mean that we've got higher levels of inflation as a result. So there's going to be some price pressure for prices to increase. Okay, so is it desirable for us to have a current account surplus as an economy? Well, clearly, if this is the case, because based on what we just defined, if we've got a surplus in the in the current account, we've got higher levels of exports than we have imports. Well, in that case, clearly that's a good thing, isn't it? Examples of countries that run current account surpluses include China, Singapore, Germany, and Norway. And if you remember back from the charts that we looked at, those were the four key countries that were, or key economies that were running current account surpluses. Okay. So in terms of how that might affect the current and how that might affect output and employment, again, thinking about this, and this is trying to demonstrate chains of reasoning, if you like. Okay. So if we think about this, if exports exceed imports, aggregate demand in an economy is going to increase. The output will need to increase as a result of that new demand. Okay. If that is the case, firms are going to need more workers to increase the output and so meet demand, and so employment will rise and wage levels will also increase, leading to higher levels of growth. Okay, so one could argue there are some real positives as far as that's concerned. However, there are some other issues as well, aren't there? Okay, if we look at this and try and explain in a bit more detail, if the economy has had a current account surplus, it must also have a financial account deficit. Okay, effectively, that is going to mean that we're going to have an impact on the standards of living of a higher current account surplus. Okay, so if we've got high levels of aggregate demand, that will lead to more jobs, that will lead to higher levels of pay, and so standard of living generally should improve, shouldn't they? But again, as with any of these things, there is always going to be a payoff, and that payoff could be that in the longer term, if we've got this increasing level of aggregate demand and increasing levels of pay, that is going to eventually mean that we're going to get some inflationary pressure. So price inflation might well go up, and if that happens, obviously over time, that's something that is an undesirable consequence that might need to be managed by the government and the economic agents within the economy. Okay. If we then take a look at the impact of standard living of a current account deficit, then obviously it's the flip side of what we just described, really. If that happens, we're going to get lower aggregate demand. That's going to lead to less jobs. That could mean lower levels of pay, and so standard of living could fall. Okay. However, in the long run, that demand also might mean that if it carries on for a long time, that can lead to negative growth and possibly into recession. And obviously, that is not somewhere that any economy wants to go over a long period of time. Okay. Okay, so let's have a look at policies to reduce a current account deficit then. Let's move myself down a wee bit. So examples, okay, things that you can do, okay. 4 different policy options. You've got devaluation as one, you've got reducing expenditure as another, you've got protectionism as another, and then you've got supply side policies as the fourth one. Okay, so those four policy issues are fairly major things that we can do to try to address the current account, any current account deficit. Okay, so let's take a look at each one of these in turn then. Okay, devaluation is something that is considered by some countries to be quite a useful tool. Okay, the first thing then to say, what is it? What is devaluation? That's where the government or the central bank could reduce the value of a currency by possibly reducing interest rates, and that's clearly going to reduce the value of a domestic currency. Okay, it could also choose to reduce the value of the currency by selling domestic currency or buying foreign currency or by increasing the money supply. Okay, each one of those is a legitimate way of reducing the value of the currency, and if that happens, then effectively, if we reduce the price of our domestic currency, the price of exports will fall, and the demand for exports should rise as a result of that. As well as that, bearing that in mind, prices of imports will rise, and so as a result of that, demand for imports will fall. Okay, and that is very much dependent on, obviously, with any of these policies, there is always going to be a bit of a payoff. It's very much dependent on the price elasticity of demand for imports and exports. Okay, if a change in price is going to mean a significant change in demand, then it will work as a policy option. If that isn't the case, then clearly that is not going to work as a policy option in the same way. Okay, so remember, if we think about what we talked about previously in some of these sections, okay, we talked about the Marshall-Lerner condition, didn't we? Okay, and if we are able to, for this to work, if this is going to work for our economy, there has to be the Marshall-Lerner condition needs to be in place. Okay, so in this instance, for depreciation of a currency to work, for it to improve its current account position in the long run, then the economy, that particular economy, the combined elasticities of imports and exports must be greater than 1. Okay, so we must have elastic demand for that to happen. Okay, the other thing to bear in mind as well is that we could actually, if we were going to try and explain that, we could talk about the J-curve effect. Okay, that's another thing that we've looked at in previous narrated PowerPoints. So where in order to for a depreciation or a devaluation in the currency, initially it's going to cause the position to become worse in the short term, and then obviously as those measures take effect, then we are going to get an upsurge, and the J-curve effect is something that you could use to demonstrate that as an example. Okay, so other things that the government can do, then it can reduce expenditure. Okay, so if we've got a current account deficit, we could try and reduce the level of growth in AD by the use of either fiscal policy or monetary policy. Okay, so for instance, if we're using fiscal policy, the government could choose to increase taxes or reduce government expenditure. Okay, those two things as fiscal policy would actually change the level of aggregate demand, and as a result of that, that could actually help to reduce the current account deficit. Okay, the other option could be the use of monetary policy. The government or the Bank of England, in our case, could choose to raise interest rates. So each one of those things would reduce the level of expenditure, and so as a result of that, that would effectively change the game a wee bit as far as demand for imports and exports. Okay, so if we had a slower rate of AD, then inflation will fall. Okay, if domestic inflation is lower than the rest of the world, then domestic goods will become more competitive, and then the demand for exports should increase, and the demand for imports will decrease. Okay, and if that is the case, then clearly, if we have a slower rate of AD growth, that will slow the growth of imports, and if imports rise at a slower rate than exports, then the current account deficit should decrease, shouldn't it? Okay, so if that, relatively speaking, that changes in a positive way, that's going to mean that the current account deficit will fall. What's the cost of reducing AD? Well, obviously there are always issues, aren't there? If we go too far with this policy, then there's a risk of recession, there's risk of job losses. We could get falling economic growth if that continues for too long. So again, it's this delicate balancing act that the government is trying to walk the tightrope to make sure that to some degree the current account deficit is reduced. But if we do that for too long and use either the reduction of expenditure for too long, that might mean that we've got an issue in terms of some of the other economic indicators, i.e. if we get growth falling, that can cause obviously recession and a risk of job losses, etc. Okay, so when would it be beneficial to consider reducing the growth of AD? Okay, well, clearly one of the things that we could do is, in order to try and manage our way through a process, well, we might be doing that to try to reduce the negative effects of inflation, okay? And if that rate starts to increase and gets out of control, that is a very dangerous thing, as we've seen in previous economics lessons, okay? So let's look at some of the other sort of questions that might be asked then, okay? So why might raising interest rates to deflate the economy be an ineffective policy in reducing the current account deficit? Well, in some instances then, okay, that could cause some positives, but could also cause some negatives. And in this instance, if we've got interest rate rises, that's going to cause an appreciation of the currency. So if we get interest rates rising, we're going to increase the exchange rate value, okay? And that's going to affect the current account in a negative way, as imports may increase and exports may decrease, okay? So on the face of it, interest rate increase could be used, but there are some issues as far as it reducing the current account deficit, okay? So it could manage inflation, but not necessarily help the current account deficit. Protectionism is the next one, okay? And that's where essentially it's another potential use of policy that the government can choose to use, which is where we're actually trying to reduce the level of foreign trade or international trade, okay? Now, obviously, there are two things that can normally be used. One is a tariff, and another is a quota designed to try to restrict imports, to reduce the level of imports, okay? Trying to protect our domestic industry, if you like, okay? Now, there is a couple of issues with that, okay? One, it restricts free trade, and clearly, if we're buying into the World Trade Organization and the principles of trade and international trade, then clearly protectionism sort of flies in the face of that. So there is an issue around that. And obviously, if we start to do that, we start to restrict goods and services being bought in our country by slapping tariffs or quotas onto imports. There's a risk that other countries might retaliate. And as a result of that, then they will maybe start to impose tariffs on our goods and services too. And obviously the classic example, the biggest example, has been China and the US and their trade war, where basically the tit for tat of one country setting tariffs at a high level and quotas at a high level, then it actually caused retaliation from the other country. Okay, so other things that we can look at, supply side policies, a number of options that we can choose from. There are a whole range which I'll just pop up and we can take a look at each one together. Okay, so each one of these things are considered to be supply side policies that can help, and these can help to achieve some balance as far as the balance of payments concerned. But there are a range of both free market economists and also interventionist economists' views as to what are the different options that can be chosen. Now, again, if we're in a situation where we're trying to look at things that can actually improve the position, there are a whole range of things, ranging from cutting government spending and borrowing and lowering business taxes, cutting red tape, improving the flexibility of the labour market. All of these things, right the way down to privatisation and opening up an economy to overseas trade and investment, are considered to be helping in a free market way, the stimulation of trade, etc., in order to try to address some of the issues around the level of the balance of payments and whether the current account is in deficit or surplus. Okay, there are a whole range of other things that can be are advocated by the more interventionist view, the interventionist economists, and that is where we're talking about the state having a much greater role in managing and to some degree influencing the economy. So it's not really the free market, it's not allowing free market forces to do so. It's very much a case of much more centralized government control to try to actually stimulate growth. And obviously in the situation we find ourselves in with the COVID crisis, there seems to be a significant amount more interventionist economics going on, where effectively, for very good reason, in order to sort of try and stimulate the economy, the government has taken a much more active role in helping to publicly finance some of the shortfalls that we're facing in what is unprecedented times. Okay, so that's it, finished basically. So that covers the last set of information on the balance of payments and exchange rates booklet. Thank you for watching once more. I know that went through at a bit of a gallop there, but there are some really good notes within your booklet. And again, any questions, if you're not sure of what we've gone through, one of the things I will be doing is setting up some drop-in sessions where we can actually discuss any of the information within the booklets. Okay, so thanks once again for listening, and thank you and good night.